Hey everyone, I'm Jeremy Szafron. This is Kitco News. If you haven't already, don't forget to hit that subscribe button for the latest. And today on the show, we're talking about the big moves in precious metals. Gold prices have hit new record highs, driven by U.S.-China trade tensions, increased seasonal demand from India, and an improved U.S. inflation outlook. Now, with prices now above $2,400 per ounce on the spot side, gold is attracting attention as a safe haven like never before. Central banks in emerging markets are also buying up gold to protect against economic and geopolitical risks. And as we turn over to silver, that metal price is also making waves, driven by strong industrial demand, especially from India's solar energy sector. India imported more silver in the first quarter of 2024 than in all of last year, pushing prices past the $30 per ounce mark. Analysts are even speculating about a potential short squeeze that could drive prices higher. So what does this mean for investors, and how can we navigate these markets and make the most out of them? Well, to break it all down, we're joined by our friend Adam Rozencwajg, managing partner at Goehring Rozencwajg. Adam, welcome to Kitco.
Thank you so much for having me. Happy to be here today.
Yeah, I appreciate your time. And as we mentioned briefly, I got a little bit of a cold going, so thanks for bearing with my voice. Let's turn over to gold. Let's start with that. Obviously, prices have recently surged to new record highs, driven by a combination of factors, as I just mentioned in the intro. But with analysts predicting further price increases, what do you think are the key factors of sustaining this rally? And Adam, how high could gold prices go?
Well, it's a really interesting question. I think we are in the early innings here of a very prolonged and substantial gold bull market. And ultimately, I think that prices could get, really out of control. How high could they ultimately get? I think if you look at long-term historical averages of different financial metrics relative to the gold price, you could make a case for $5,000, $6,000, $7,000 gold. You could make a case if it gets radically overvalued for over $10,000 gold. I know that sounds outlandish, but there's been several times over the last 120 years where every dollar of U.S. currency has been backed by $1.40 worth of gold. If you did that math today based on how much money's outstanding, the numbers are huge. But I don't think that necessarily happens in the short term. I think that's sort of our longer term price target. What I think you're starting to see happen now, and what's driving the gold price today, is really central bank buying. And it's central bank buying from all around the world over the last 18 to 24 months. We've seen central banks buy well over 1,000 tons of gold. That's the fastest pace of accumulation we have seen since we've gone off the gold standard in 1971, or the Bretton Woods standard. So that's really what's been driving things so far, has been the central banks. And we can talk about all the reasons why we think that might be happening.
Yeah, well, I mean, if central banks begin offloading their gold reserves, could this lead to a significant market volatility? Is there any mechanisms that are in place to mitigate those risks, kind of like 2008?
So I think that the short answer is no. Central banks are free to do what it is they would like. But I don't think that we will see central bank liquidation anytime soon. In fact, I think we're actually going to see quite a bit more central bank accumulation. So the way that we think about it is that until we see any evidence to the contrary, I think this trend is going to continue in terms of the central bank accumulation. Why do I say that? Well, if you go back over about 150 years, 170 years of studying commodity markets, every time that real assets get really, really, really cheap relative to financial assets, and all we're doing there is we're taking the commodity price and we're dividing it by the Dow Jones, that's the longest running stock index that we have. When you get these periods where commodity prices or real assets in general become super dislocated, what you often get, believe it or not, is a change in the global monetary system. That happened in 29 when we went off the classical gold standard. The next time it got that cheap was in 69 when the US dollar went off gold. Then the next time it happened was in 99. And that's the time when all the Asian currencies pegged their currency to the US dollar at this below average rate to spur their exports. So we're in the right zip code for central bank upheaval right now. And that's what I think is so important. And so when we started to see the central banks buying gold about 18 months ago, that didn't surprise us because we're in the right neighborhood, or the right zip code, as they say here in the States, to see monetary regime change. And I think that's exactly what we're seeing now. So until there's evidence to the contrary, I think we continue down that path.
Okay, I mean, we talk about the Fed probably implementing some rate cuts here. A lot of people talking about gold prices exceeding 3,000. I mean, you just said possibly 5 to 10, obviously looking at long term. But What economic repercussions could such a rise have? I mean, do you see this leading to a fundamental shift, like you just mentioned? Unpack this a little bit. Even a new gold standard here?
I think the outcome of this is completely unknowable, but I think that in any case, gold ends up taking on more of a monetary role than it has at any point since 1970. I don't think it's likely that we go back on a global gold standard for several reasons. First of all, it's incredibly inflexible. And second of all, the price of gold that would be necessary to effectively monetize the world would have to be so high. So I suppose it's possible, but I don't think that's the base case. Gold is simply too scarce in an economy of this size. Instead, what I think today the most likely outcome would be, and you know, like Keynes said, I reserve the right to change my mind if I see the facts changing. But what looks most likely as of today is a trading bloc likely centered on the so-called BRICS countries that are trying to get away from transacting bilateral trade in US dollars. So right now, the quintessential example that we like to use, if Australia sells coal to China, it's priced in US dollars. It's not priced in renminbi, and it's not priced in Aussie dollars. And in fact, 90+% of global trade is like that. And there's a big push by several countries, notably the so-called BRICS, so Brazil, China, India to a certain extent, to begin to move away from the US dollar and use a different currency. So right now, the currency where most of these trades are happening, and you are getting quite a bit of, for instance, trade between Brazil and China, that's all priced in renminbi. However, in that world, the renminbi is not convertible. So you all of a sudden, if you're a Brazilian iron ore exporter, you end up with all this excess renminbi. And what do? If you have the excess dollars, you could go to London and buy a nice townhouse in Belgravia and a villa in the south of France. But if you're stuck with renminbi, what do you want to do? You know, you're not going to buy a second home in Chengdu. So what's looking more and more likely is that you'll begin to repatriate that money back by exchanging it for gold at the Shanghai Gold Exchange. And that seems to be what's happening today. So as of today, it remains an open question. That would be my best guess for an alternative monetary bloc to try to rival the US dollar. Doesn't happen overnight. I don't think it necessarily means the demise of the US dollar. In fact, you know, when the US went off gold in 71, it became more and more relevant, not less so. So who knows what the future holds, but I think gold plays more of a role going forward, and that's why it's catching a bid today.
Yeah, and you know, you mentioned, Adam, I mean, with the ongoing de-dollarization efforts where countries are conducting more trade in currencies other than the US dollar, how do you see the trend in the long term here affecting the prices? Could this be a long-term catalyst that wasn't necessarily there before?
Absolutely. I think it certainly will be. And again, you know, it might sound like a crazy black swan thing to say, but in fact, this is basically what we see every time that hard assets become super cheap relative to paper assets. And why is that? I don't think it's a coincidence. I think what ends up happening is that in the periods of time when real asset prices and commodity prices become so cheap, and speculative financial assets, whether it's the radio stocks in the 20s or the conglomerate boom in the 60s, .coms in the 2000s, or, you know, Bitcoin and non-fungible tokens in this cycle, whatever it is, as these completely intangible assets get bid up and real assets become cheap, the central banks have a little more cover to run looser policy for longer, and they get themselves into trouble. And the first time we had quantitative easing was actually in the mid-20s, 1920s, not 2020s. And at the end, it just goes too far, and so you get this realignment. So I do think that we're in that, again, what I call the right zip code for a major realignment. I think you could have made the argument 10 years ago that we were as well, except there was no evidence it was happening. We didn't see people moving away from the dollar. We're seeing it now. And so until see otherwise, I think that's going to continue. Is that a catalyst? That's a huge catalyst, not unlike what we saw in the early 1970s and the late 1990s. So major shifts that took place there. And I think we're seeing another one today.
Yeah, and I mean, as you mentioned, it's kind of a cyclical approach in the commodities. I mean, we certainly see it when ETFs and the spot Bitcoin ETFs were approved, the inflows. It almost is the flavor of the day, but does this create a bubble similar to the .com or housing bubbles? And more specifically, what indicators should investors watch for to avoid being caught in a potential gold market bubble?
So the answer is it definitely does run the potential. And just like every commodity cycle that's gone before it, I think this one will end with investor euphoria and huge amounts of money pouring into the space and ultimately being invested in new projects and bringing on too much capacity at the wrong period of time. People talk about how the gold producers or the oil producers have sort of found discipline or found religion. I don't think any of that's true. I think by the time this is all said and done, it'll be a bubble no less. However, what's important is that we are so far away from that today. And you talked about ETFs, and I think that's a really great point. With gold making an all-time high, you might think that the ETFs were just piling up on gold left, right, and center. But actually the ETFs, which I would call the speculative demand for gold, right? That's how most Western speculators like to swing around gold pricing today or gold investments today, certainly the hedge funds. That was at 94, million ounces back in June of last year. And today it's down to 80. In fact, since the beginning of the year, it's shed 6 million ounces, and it continues. So we haven't, you would be hard pressed to look at the chart of the ETF holdings of gold and tell me where you had a new all-time high. Similarly, if you want to talk about people that have no investment interest at all, forget gold prices and look at the gold stocks. Those are nowhere near bubble territories. We've seen 10% sell off, or not sell off rather, but liquidation of 10% of the shares in the various GDX ETF in the last 3 weeks alone. So, we're nowhere near bubble territory. These companies are trading at 0.5 times NAV and 4 times earnings. That's not where great bubbles end, nor is it with gold backing the various fiat currencies at such a low rate as it is today. So it definitely will end badly, just like it always does, probably 10 years from now, with gold 5-fold where it is today and gold stocks being the best asset class of the coming years, I suspect.
Okay, of the coming years, let's break that down. I mean, is this the year of gold stocks? We've seen the divergence, obviously. It hasn't really caught up to the metal prices, but, looking towards it, is this going to be the next play? I mean, silver, we're going to get into it in a moment. It's finally starting to catch up a little bit. Is this decoupled, or are we going to start to see some nice movements on the equity side?
I think we will. And, you have to know what you're good at and what you're less good at. And we're pretty good at getting the big fundamental drivers right. I'm not particularly great at market timing. In fact, I tend to be early on a lot of the things that we do. So is this the year? I sure hope so. We're positioning ourselves accordingly. We've been adding to our gold investments here. And I think that the time is getting closer day by day. And I think it could certainly be it. As far as whether gold stocks have permanently decoupled and things like that, I don't think that that's really the case. Back last cycle, there was a moment where gold popped higher and the gold stocks kind of lagged. And that was because the GLD was introduced as a new instrument, and that attracted the kind of incremental investor dollar, not necessarily towards the gold stocks. But actually, in the last 7 or 8 years, gold stocks have done what they ought to do, in the sense that when gold goes up, they go up with even more leverage. The only time that that's kind of decoupled has been in the last 18 months or so. And I think the answer is actually fairly straightforward. Over the last 2 years, we've had a real rate hike cycle in the West. And Western investors and speculators have been conditioned to do one thing in the face of real rising real rates, and that is sell everything gold. And again, you can see it super clearly when you look at the holdings of the ETFs, either the GLD or the GDX, which is the shares, or the GLDs, which is the physical metal. Western speculators have been shedding everything. And the central banks, and predominantly the Eastern central banks, have been the ones doing the buying, again, because potentially they're setting up this alternative currency block. Potentially they're getting worried about how the US is weaponizing the dollar, or just the fact that, war seems to be spreading now on a global basis, whatever the reasons may be. But while they're buying gold bars hand over fist, one thing they don't buy are gold shares. So in the West, you have the speculators selling gold bars and gold shares. And in the rest of the world, they're buying the gold bars, but the stocks are gone no bid. So we see a huge opportunity. I don't think that's decoupling at all. In fact, I think when the Western speculator begins to come back to the gold market, that will play a huge catch-up rally and close that gap. The question, of course, like always, is when.
Yeah, a lot of people happy to hear that one. As you mentioned, there's a noticeable divergence in gold investment behaviors between Eastern and Western markets. And, it's a crazy year. We have a lot of countries in the G7 nations going into elections. You have one in the U.S. How should Western investors and policymakers respond to the shift here, in your view?
Well, as far as policymakers go, I mean, the dysfunction and the turmoil that's now spreading around the world, I wouldn't dare to say what I would expect policymakers to do. But I think in general, investors and policymakers need to be, I think, a little bit more aware of the tail risk of major changes. Again, if we had talked 10 or 15 years ago when real asset prices, for instance, were really expensive relative to financial assets, and you said, oh, the dollar reserve currency is at risk, I would say, well, it's a kind of a strange time for that to happen. Historically, going back hundreds of years, you get these big kind of systemic changes when you seem to really dislocate the price of real assets relative to paper ones. And that's where we are today. So I think leaving yourself open to the possibility of that black swan event, that tail risk where something different actually lurks on the other side is very, very important. What does it mean to the average person? Well, the average person and the average Kitco listener might not be exactly the same, but I think it means, making sure that you're well diversified and have a healthy allocation to gold, and whether it's to gold bullion or to gold shares, I think you'll do better. You'll do well with both. It's really a question of your risk tolerance.
Let's talk silver. It's been on a significant rise on the price side, nearly 25%, obviously driven by strong industrial demand from sectors like EVs, which you've talked about, and solar energy. Considering India's substantial increase in silver imports to the solar build-out, do you think silver could become as important as gold in the investment world here?
Well, it's interesting. Silver has always been what they call the poor man's gold. Yeah. Obviously, you can make a ounce investment for a substantially lower price. And people have often wondered whether or not that would change now that you can buy so-called electronic gold, whether the GLD or other vehicles, where you could effectively put $25 into a gold investment just like you could into an ounce of silver if you so chose. I think the jury's still out. I think that silver today continues to act as a quote unquote poor man's gold. And there's often a view, which I think is fascinating, and my colleague and partner Lee Goehring has done a lot of work on, but there's this view always that to have a strong precious metals rally, silver has to outperform. And that's not exactly true. What does tend to happen is that silver tends to lag gold and lag gold and lag gold throughout the rally. And then it stages this massive, furious catch-up, so that by the end of the cycle, they've both gone up, comparable amount, but it kind of sticks in everyone's mind, this huge silver surge, because it happens in this compressed time right at the very end. And that's actually, when you do get that massive catch-up rally, that's not necessarily the best indicator for precious metals, either gold or silver. It actually tends to be preceding a period of consolidation in both. And the last time we got that was back in 2020 and 2021, when the Reddit crowd tried to corner the silver market in, January of 2021, and ultimately failed. You had this huge catch-up rally in silver leading into that. And then ultimately that spelled sort of pause in the gold and silver bull market for the next really 3 years or so. So, we're not seeing that yet. Yes, silver has done nicely here, but it's still undervalued relative to gold. And I suspect, just like in past cycles, it'll lag and then stage some massive, furious catch up. And right now, we would favor gold over silver.
Oh, interesting. Okay. I mean, there's speculations about a potential short squeeze in the silver market that could push prices, towards $50 an ounce. How realistic is this scenario, Adam? And who stands to gain or lose the most if it happens?
Potential short squeezes in the silver market have been a thing of rumor for many, many years. There's been a lot of different views on that, trading desks like at JP Morgan and what have you. I have never subscribed to those views. We're gold bulls today, and positive on silver, although I would prefer gold if I given the choice. But we're not gold bugs, and we don't necessarily subscribe to some of the more colorful theories that some of the community puts out there. And I think that was given a good test with that Reddit squeeze, where, if in fact that big financial institution short squeeze in silver was present, you probably would have seen the capitulation there, but you didn't. It lasted a couple days and then it came right back off again. So I don't know. It's hard to say. Like you said, there's a little bit more industrial underpinning today, might be a little bit more real, but I don't think that that's particularly likely here.
Yeah. I mean, you've been bullish on uranium, looking at the other commodities here. Obviously, there's a critical role in global energy strategies here. There's a push for the carbon-free power sources, particularly in China and India. But how do you see the role of uranium evolving in the energy mix? And give me your outlook here.
Uranium, I think, is one of the most fascinating commodity markets out there for a couple of different reasons, which we can get into. It's not, an uncovered story anymore. It's now kind of come to the light, but I think that the rally continues to have legs, and I think we'll see uranium prices move higher from here. We're maintaining our uranium positions. In a couple cases, we've trimmed a little bit just on some real strength, but it remains a core position for us, uranium producing equities and development companies. It remains a core position in our portfolios. And I think what's really fascinating about the uranium market is that for the first time since we've split the atom, we now have a structural uranium deficit. That might sound like a crazy thing to say, but throughout most of the 60s and 70s, as nuclear power proliferated, actually uranium mines proliferated even faster. We had a few speculative high-tech uranium mining booms throughout that period of time. And so we always had more uranium than we had reactor demand. And the surplus was always bought up by governments to basically try to prevent other governments from buying uranium with which to make weapons. By the early 80s, finally, the Soviets said, look, this is ridiculous. We have way too much uranium here, and we're kind of going broke. How about we reclassify some of this government stockpiles into commercial stockpiles and sell it into the reactor markets? And in fact, we can then also tell the world that we're, de-weaponizing and what they called the megatons to megawatts project. And that was successful in providing tons into the market. Uranium prices collapsed because of it through the 80s and 90s. Total uranium mine supply fell by nearly 50%, and it was all made up for by these stockpiles. The stockpiles ran out in the early 2000s. Uranium went up tenfold, and then Fukushima happened. And with Fukushima, we replaced the government stockpiles with commercial stockpiles because 30% of the reactors went offline.
Right.
And we still produced uranium with which to power them. And so those found themselves in these big commercial stockpiles. Those stockpiles ran out in 2022. So for the first time, with no exaggeration, for the first time since the Manhattan Project, for the first time since the atom was split, we now have a structural and primary uranium shortfall, and it will only be closed by bringing on new mine supply, because a nuclear reactor can withstand $200, $300, $400 uranium prices and not impair the economics. So there's no demand destruction to come. It's really tricky to bring on production in the short order. Existing producers, whether it's Kazatomprom or Cameco, seem to be challenged. NextGen is the next one everyone's watching, but I think that timeline is a little bit aggressive too. And so it's going to have to be priced to squeeze it out, but that's going to be a difficult task. And so I think it's a very interesting market based on today's fundamentals, to say nothing of the future increase in nuclear power going forward.
Yeah, it's wild. I mean, you talk about it. We had the destigmatization of it, where people realize that we're going to need this in the mix, especially in an AI world, in this technology evolution. We're going to need nuclear power. So I'm kind of curious here. Is it the perfect storm? And is it going to happen this year? Are we going to see this happen again, like a cyclical approach? I mean, the next year or two is looking to be interesting.
It's looking to be very interesting, again, because a lot of it, you don't want to say things are set in stone, but I get a question all the time. Well, when are the new nuclear reactors coming online to really tighten this market? And I said, guys, you don't understand what's happened here. In this market, what you're seeing is market that's been in deficit for 3 or 4 years, masked by a one-time inventory overhang, and the inventories are now eroded. So that's what people have yet to understand. We're not talking about small modular reactors. We're not talking about AI demand. We're not talking about a reshift away from renewables towards nuclear to solve our climate goals. We're just talking on what's happening today. And that's what's so dramatic is that what's happening today has been masked, and it's now coming to light. So uranium prices bottomed at $19 back in 2018-19. They're flirting with $100 today. Where do they go? I don't know. You can't bring on material in the short term for $200. You can't bring it on for $300. So I think that we could have a really what we call a violent move to the upside, and a very frenetic and chaotic move as well.
And is that going to happen over the next couple of years, you think, here, Adam? I mean, we see a lot of these miners going to old properties in America. We saw the ban of uranium with Russia. It seems, again, perfect storm, and it should be probably short term.
I suspect it will be throughout this year, next year, and the year after. And then ultimately, we like to look for these, what we call these kind of off-ramps to the bull market. So even though we take really long-term views, we like to stress test ourselves by saying what will ultimately derail this. And it will be new supply eventually. Given $150 uranium prices long-term, you can bring on new mines with enough time, but it's going to take some time. And I think it'll be, from now to the end of the decade, will be a very, very exciting period for uranium.
Yeah, well said. Adam Rozencwajg, managing partner at Goehring Rozencwajg, joining us to break it all down from New York. Thanks for coming on. This was great, Adam. I really appreciate your time today.
Oh, thanks for having me. Really enjoyed it as well.
Yeah, we'll speak soon. And for all of you at home, I'm Jeremy Szafron. For all of us here at Kitco News, thank you for tuning in. Lots of great content coming your way. Don't forget to hit subscribe and like that video, and leave me a comment on who you'd like to see on the show next. We'll see you next time.